You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, do you think you're overpaying on your taxes? Would you like to save 30, 40, 50% or even more and do it all legally and still retain your advisors, your professionals? Well, the person you're about to hear from can help you do it legally, ethically. Ethically, when it comes to taxes, your one duty is to yourself to legally minimize your taxes, pay the least amount legally permissible. That was said by Judge Learned Hand many, many years ago. It's as true now as it ever has been. So Mark Myers is with us. And if you got a question about taxes that Mark can help you with, just send an email to me, Kerry Lutz, KL@kerrylutz.com. Mark, welcome to the show here. Hey, you're a former Marine, so you shed blood and tears and sweat defending the country. Now you're trying to help people minimize their taxes, which arguably by perhaps the less cognizant might think that that's actually hurting the country. Actually, the more of us who pay less taxes, the more the government's got to reform. So you're really doing a service for us, aren't you?
Semper Fi, Kerry. I really appreciate you having me on the show. And yeah, absolutely. I feel that, as you mentioned, Judge Learned Hand said it best. You're only responsible for paying your fair share. There's two systems in America, two tax systems, one for the informed, one for the uninformed. Both are legal. So when we can actually keep more in our pocket and we can get that money circulating, I think we've got something special in the United States. So thank you again.
All right. So there are two systems, you said, one for the informed and one for the uninformed. So just give us an example.
A good example of that, Kerry, would be that let's just take business owners, for example, and let's look at small to medium sized. And when we go small to medium sized businesses, it can literally be up to $150 million in total revenue. And that's still considered a small or medium sized business, let's say medium. But most small to medium sized business owners don't realize that they can actually benefit from about 20 different tax-free fringe benefits that are in the tax code. They've been there for decades. They just need to be structured in a way that they don't have to offer them to all of the employees that they currently have in their current company. So, for example, if they knew, structurally speaking, they could set up a new entity that could handle some marketing and management type activities and invoice their current entity, well, they could get out potentially up to $150,000 per year in benefits from this new entity that are not taxable.
Mm-hmm. Interesting. So setting up a subsidiary or an independent company that manages marketing or maybe manages administration, maybe does HR or something like that, as long as it has a legitimate purpose and its sole purpose isn't just to enable you to pay less taxes, correct?
That's 100% right. The IRS looks first at, they want to look at a substance and form, and you don't want to have too much of either. But essentially, you want this entity to provide a tangible, viable service, and it needs to be have economic substance to that service. Now, the question then becomes, how much of the service do you want it to perform? And when we're looking at these, we can call them marketing management companies or fringe benefit companies. We don't want it to earn more than it can ultimately extract with the tax-free fringe benefits. So we're going to cap the earnings, and they are capped because there's essentially about 20. So there's only so much you can do. But this is just one, we call this low-hanging fruit in the informed tax realm. But the key here, Kerry, is you have to do it right. The structure has to follow the right designation. It has to have the right structuring so it doesn't fall under IRS rules with regard to controlling consolidation. So when you're working with this type of efficiency, you need to be doing it with the right guidance, the right Sherpa, so to speak. So that's really important as well.
Yeah, because one false move and they'll be all over you like white on rice, right?
That's right. That is exactly right. And of course, they have to follow the same rules we follow. So the IRS doesn't have any more advantage than we do. If we're following the rules that are clearly stated in their code, and there has been, it's even better if there has been some type of Treasury ruling or some type of court case that shows precedent. Well, you are clearly in the black and white. You just have to make sure that you're not stepping outside the boundaries.
Right. So, and that's where having a professional there can really make all the difference. Don't try this at home, as they say, kiddies, but seriously, so what's the biggest tax break you've ever gotten for somebody?
Well over 7 figures. These are, to give you an example of these type of opportunities, and this is going to be active income. So, Kerry, I think it's important for us to talk about, capital gains tax as well on the long term. So people are selling businesses or equity in companies that they own, or potentially real estate that they've had for some time that's appreciated. There's other elements of reducing and eliminating capital gains tax. But to your question, let's focus on active income. So one of the most recent companies that, I've worked with is a group that's in California. And of course, as we all know, it's easy to ramp up your tax bill in California and New York and Illinois and Minnesota and other states that have that high tax impact in addition to the federal side. So this company, the owners in this company had about $5.5 million of taxable income between the owners. It is more of a distribution and a company that had a pretty strong amount of cost of goods. They sold a certain type of product for personal hygiene. And what we realized is that they could have a division that provided prominent services to them, just like the large companies have, in an economic development zone. So we were able to reallocate services that the company was currently completing in California, but we now relocated those services into an economic development zone, and we were able to pull over $2 million per year to be earned through this new division of the company in the economic development zone. Well, why did we do that? Because in the economic development zone, there is a 4% corporate income tax parameter, and there's a tax exempt dividend for the owners of those companies. So we were able to essentially relocate over $2 million worth of their profit. And because they're all in the 50% tax bracket in California, we gave them 7 figures of tax savings, which was all liquid, by the way, Kerry. This was not something they had to tuck away into a cash balance plan or defined benefits plan. This was money that they could reinvest in the company or go to Vegas with.
Well, or reinvesting in your company could be the equivalent of going to Vegas. You never know. Hey, I've been thinking about for quite a while moving to Puerto Rico. Because in Puerto Rico, there's no U.S. income tax. You pay 4% tax on your earnings there. Your capital gains can be sheltered depending upon the timing of things. Is there a better alternative than moving to Puerto Rico?
That's a great question, Kerry, and we get it all the time because obviously Act 20, Act 60, Act 22 have been around for close to a decade now, and there's hundreds of large companies that are in Puerto Rico specifically for their very stable economic benefit. When you're looking at an economic development zone, you want it to be around for a while. You don't want it to be at a whim and change, like maybe the parishes in New Orleans. After Katrina, they had a nice economic development zone, and that lasted for about 6 or 7 years. In the boroughs in Manhattan, they've got enticements to new business owners to set up shop there, and they give them 10 years of state benefits. Whereas with Puerto Rico, you've got 30 plus years of grants that you can acquire that are still available. So to your question, the bigger companies realize and understand that they can set up divisions in Puerto Rico, take advantage of the 4% corporate income tax and the tax exempt distribution to owners above and beyond, but they do not have to live in Puerto Rico for over 183 days. Most of the thousands of small business owners that are flocking to Puerto Rico are moving there to take advantage of this benefit because they don't have the advanced legal team to understand and help them how to plug into this opportunity, but also to not have to move your entire life to Puerto Rico. Now, if you like the tropical environment and you want to have 100% of your profit taken at that rate, great. But if you don't want to live 183 plus days in Puerto Rico, well, there's options. You can actually have a portion of your earnings from your company be earned in Puerto Rico, and you can benefit from those grants and the exempt dividends if you're utilizing the right structures and the right planning.
Right. So that would probably involve a C Corp or something to that effect set up there that handles certain functions, right?
Absolutely.
Okay. Interesting. I hadn't considered that. So you can get the benefit of the Puerto Rican tax rate without it being held for ransom, the price of which is living there.
That's right.
All right. So interesting. You know your stuff. So, just as a little aside, I always came from an entrepreneurial family. From the time I got my driver's license, my father always drummed into my head, get the receipt from when you pay a toll on the New Jersey Turnpike, or you're going in through the Lincoln Tunnel to New York, get the receipt, because it's a business deduction. And when you fill up with gas, get a receipt. So a lot of those lessons were drummed into me at an early age. Besides moving to Puerto Rico, without giving away all your secrets here, what's the next largest potential tax strategy you can utilize?
Don't just survive, thrive. The Financial Survival Network.
Today's show is brought to you by Mustango River Resources. Their flagship projects are located in Kirkland Lake, an established gold camp that has historically produced over 70 million ounces of gold. The Kirkland West project is a high-grade gold project beside Kirkland Lake Gold's world-class Mikasa gold mine, one of the highest-grade mines in the world. Umeja project is an advanced stage project with 600,000 plus ounces of gold along the Cadillac Break, 25 kilometers east of Mikasa. Their projects have the potential to transform into another world-class mining camp in the Kirkland Lake District. Make sure you go over to Mustango.com. That's Mistango.com. Take a look and sign up for notifications. Stock is traded on the Canadian Stock Exchange, ticker symbol MIS. For more information and to sign up for notifications, go to Mustango.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
That's a great question, Kerry, and I can go in a lot of different directions. And that great advice, by the way, by your father, right? Keeping all the records, because when the IRS comes a knocking, you have to be able to show them your policy, why you're doing what you're doing, keeping copious notes on how you're doing it, and obviously following the code as to what the code says you can do and how to do it. So I love that advice from your father. But I would say let's go in this direction. Let's go in capital gains. A lot of people have appreciated assets that they're looking to sell. And of course, depending on the state that you're in, you could easily climb up into the 30 plus percentile when you're adding the state element. But even if you're in Florida, even if you're in Nevada or Washington State or Tennessee, you're still looking at, if it's a highly appreciated asset and your basis is fairly low, if you're looking at $1 million or more in gains, well, that's at least 20% on the federal side. Plus, you're going to look at a 3.8% on top of that in most cases. So 23.8% of $1 million gain, that's a $238,000 tax bill. A lot of people don't want to see that. If you multiply that asset by 20, some people are selling a $20 million asset with the basis of 2 or 3 million. Now they're looking at paying potentially 23.8% up to 33% in California. So now we look at, well, how can we ensure that you don't trigger that capital gains tax event? Because as soon as you take constructive receipt of the proceeds, the IRS has their hand out. So when you're selling an asset, how do you structure that sale prior to the sale is so key. I can't tell you how many times, Kerry, I get calls from people that say, I just sold a piece of property. It was $4 million. I had no basis. I owe $600,000 in taxes. What can I do? Well, yes, there are things you can do after the fact, but I say, I wish you had to talk to me prior to the sale.
Ounce of prevention, right?
Ounce of prevention is worth a pound of cure. And really, when we're going in that direction, we're looking at structures that you can utilize, or assign the asset into this structure using a qualified intermediary and a trustee or some type of a trust structure where when the buyer goes to buy that asset, well, they're not paying you. They're paying the asset dealer or the qualified intermediary or the trustee, and the money goes into a trust which you control. And the good news is the IRS doesn't have their hand out, and depending on the mechanism you're using depends on how flexible you can be with the money that's in that environment. Some environments are much more flexible than others, which means that you can put 100% of that work or close to 100% of that money to work to your advantage. And of course, your distribution from those instruments can be very beneficial for you tax-wise, depending on the need that you have and depending on the structure you use.
All right. Interesting. So that's just one example. And we've got passive income. And if you have passive losses, it can offset your passive income. So I know about section, was it 279? Was it bonus depreciation?
Section 279, I would say, Kerry, and I don't want to step out of my comfort zone and my area of expertise, but when it comes to passive income, my knowledge and the groups that I work with, they really focus more on the active income side, taxable income from profit via business, income from W-2 earners. We actually have solutions for W-2 earners, which is they're hardest to help when you're earning, $300,000, $400,000, $500,000 a year or more, and you have no choice but to do the withholdings unless you know more. And then, of course, capital gains. So when it comes to passive losses, I'm still looking for great solutions outside of real estate. So if you find any, let me know. But those are the hardest to work with.
Sure. I understand. Hey, what about the idea of you're setting up a new company and you have 6 kids, say, and you give them all a piece of the company. And then I know there's a kiddie tax, so they're going to get taxed at your rates. However, it could really be a great tax savings, couldn't it?
It definitely can. I mean, when you're looking at assets that essentially are going to benefit your kids or your heirs, so to speak, looking at, again, the ounce of prevention mechanism is best. And it may be that you're structuring entities, putting your family within those entities, whether they're companies or trusts, and ensuring that you're moving assets into them appropriately to make sure that you're, limiting your personal tax liability and obviously giving them a fair shot at it when it's their turn, right? Because we can't take it with us. A lot of people might think that they would like to take it with them, but they can't.
But it's not really going to be effective, is it?
That's right.
Yeah. So but using your kids. I know, like Rich Dad, I think Ken McElroy says there's absolutely nothing wrong with using your children to shelter income, right? Your minor kids.
That's right. And, low-hanging fruit on the entity that I mentioned in the very onset with the fringe benefits, there are provisions in the tax code that allow for deductions to occur for things that your kids may be doing, college tuition, there are certain activities or marketing activities that you could assign to your kids because they're pretty babies or average babies. It doesn't matter.
Nobody has an average baby. Everybody's very extraordinary and should be fit for modeling, and the smartest kid in the world, at least all 3 of mine were anyway. I don't know about yours, Mark, but seriously.
Absolutely.
Seriously. So utilize family structure to minimize taxes, right?
Yes.
So because obviously to your children, any income they derive from a corporation you set up or a company is going to be passive income to them, which means that passive income can be offset by passive losses. And Section 279 could be beneficial there. But again, you have to go to your accountant. And one of the things I liked about your write-up, Mark, is you don't encourage people to dump their CPAs and their tax attorneys. You work hand in hand with their existing professionals to come up with the best strategy.
100%, Kerry. Our focus has always been a blue ocean approach, because when you think about the chasm or the gap between Americans that build a business on their back. They essentially start with nothing, they bootstrap it, and all of a sudden, overnight success, 15 years later, they're paying taxes on $500,000 or $1 million per year or more. Well, they're likely not going to be the ones that are chomping at the bit to go knock at Deloitte and Price Waterhouse and KPMG's door to get work done. They're going to be very true to their CPA, local or regional, which probably is really good at the accounting work that they do, which is what they're trained for. But when it comes to integrating in the legal components and navigating the 70,000 pages of tax code, you need help. So we essentially like to partner with. We're not looking to say, hey, oh, by the way, we're going to do accounting work better than your CPA. Oh, by the way, we have advisors that will give you better financial advice. No, most of our business comes from advisors. It also comes from accountants that are forward thinking and knowing that they don't, there are areas of tax exploration and law that they don't master, and they want the best for their clients. And I'd say that 3 or 4 out of the 10 CPAs out there are going to be the ones that are going to say, yes, I want to do everything I can for my client, and I'll introduce them to these resources. I mean, I always use the analogy, well, if you went to your primary care physician with a excruciating headache in your frontal lobe and time over time, they said, it's just the pain that you're going to have to deal with. I've done everything we can do, but you never went to a neurologist that said, hey, you've got a 3-pound tumor here. We need to do some treatments, and these are the things that we're going to do. Then that would be problematic. And unfortunately, that's what happens in America now, because most accountants and CPAs don't realize that there are solutions like ours out there. But if there are, they're thinking, well, they're just going to take my clients away, so I'm not going to introduce them, or I'm not going to open that door up. So this is where we come and say, hey, we want to be your friend. We want to be your partner. We want to be an additional player on the team.
And that's perfect. There's nothing wrong with expanding your team. Hey, if you want to find out more about what you're doing, Mark, and maybe connect with you on the web, what's the best way to do that?
If they go to peakprofitsolutions.com, they can learn a little bit more about me, and there's some resources that they can grab there to immediately get some more information and maybe even look at some case studies. And that's peakprofitsolutions.com.
All right. And there's a link to that in the show notes of this interview on Financial Survival Network. And make sure you sign up for our free newsletter. Mark, been quite enlightening, and we'll be happy to have you back on the show in the future.
Kerry, thank you so much for having me. It's been a blast. And you taught me a little bit about the passive income side with 279. So thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.